Well, welcome everyone to today's webinar titled From Tariffs and Chaos to Control. This is Brian from Strategic Treasurer, and we're pleased you could join us as we discuss the results from the Tariffs and Treasury survey and what treasurers and CFOs should be doing to improve cash visibility and risk management in these uncertain times. Our speakers for today are Leo Gill, Vice President of Product at Bottomline, and Craig Jeffrey, Founder and Managing Partner of Strategic Treasurer. Welcome, Leo and Craig, and I'll now turn the presentation over to you.
Thank you, Brian. Welcome, everyone. Good morning, good afternoon, good evening. I know there's people from all over dialing in and even still now connecting. Leo, it's good to talk with you again. It's been a few years, I think, maybe a year and a half since we did our last webinar together.
Yeah, for sure. Glad to be here.
It's good. And thanks everyone for taking some time, part of your day, to cover the results of one of the flash surveys that we have run. This is from Tariffs and Chaos to Control. Here's our agenda. I'll just cover that briefly. What are we going to be talking about? So we'll cover information about the flash survey. It was flash, meaning it was very quick. It ran for less than a week. Or about a week, and we have we'll follow that with some of the latest news, some of the news that's appeared in the last 24 to 48 hours on tariffs. There's certainly a lot developing, so we'll catch some of this rapidly unfolding news for context of what we've heard from the survey. When the tariff impacts, what are the organizational effects? We'll look at economic as well as action and reaction that your peers have taken or are taking across several different dimensions. On the risk mitigation side, how are people planning? How are your peers planning on spending or changing their behavior to address this? We'll pay particular attention to what they're doing with technology, data, and consulting. And that feeds right into tariff preparation. What other actions are they doing? And one thing here, I'll just say this at the beginning. 41% of management at organizations have asked their finance group treasury, what are the impacts of tariffs and how will that affect their organization? So 41% is that number. 68% are doing something. So 68% of organizations are taking steps, actively doing that. So we have 27% of organizations that haven't been asked by management who are proactively taking steps. Others may have proactively taken them, but have also been asked in the interim. So you can see that the majority of your peers, the vast majority of your peers, are taking steps to prepare for tariffs, even if it's just looking to see what the reaction might be, modeling activity, ensuring you can see all your cash, and so forth. There's quite a bit of tariff preparation. And then at the end, Leo and I will talk about some of the key takeaways. We'll focus on cash flow, automation, and having a proactive posture. So that's our agenda. Those are the topics we're covering today, and we are so glad that you're here. Now, our survey quick stats, before I go into all of that, or into this small bit here, Leo and I, and Bottomline Technologies and Strategic Treasury, want to thank everyone who took this survey. So those of you who took the survey, thank you so much. For those of you who didn't, please take the next surveys that we asked for. They're quick, and you will find that you learn from them, even while you're answering the questions, just like you attend a webinar to hear what others are thinking. There's significant value to it, and this is very helpful. So we really appreciate working with Bottomline to do this flash survey on late-breaking activities with regard to tariffs that are certainly on the news. But how are your Treasury and finance peers reacting? So the quick stats, we had about 100 respondents. We have way more people on today's webinar than we had respondents to the survey. It's a good, healthy number. And then the survey ran for just over a week, and there was 10 questions for corporate respondents. I think there was 5 questions if you were a banker, so you'll get slotted into a different set of questions if you were a banker. So you can see that 81% were from corporates, corporate practitioners, treasury, and other areas of finance. And just under 1 in 5 came from a number of banks. All right, so what are some of the news on tariffs? I think it's very helpful to see some of the activities that have occurred recently. In fact, in addition to what you see here, there's some recent news from the Wall Street Journal about auto tariffs or additional tariffs, especially if Canada and the EU join together to cause harm to the U.S. There's some additional challenges and of an additional 25% threats there, so worth reading that. But worldwide, we can see U.S. tariffs on imports of steel and aluminum from all countries started about 2 weeks ago, and then later on in March, just yesterday, 25% tariffs on imported vehicles, so vehicles not made in the U.S. And this, we're just trying to report facts. We're not getting political by any stretch here, but just seeing that follows some of the promises the Trump campaign made to some of those industries, and is following through as the current administration takes place. Nobody failed to respond to some of the tariffs placed on other countries by the Americans. And so you could see some kind of targeted counter tariffs taking place on U.S. goods starting next month on certain goods, a little bit more on American whiskey. So that means maybe we'll have discounts here in the U.S. On the whiskey, but in U.S. responded with 200% tariff on European alcoholic beverages. So this kind of escalation in some targeted areas is taking place. You can read some of the tariffs that you see under Canada and Mexico. China, we've seen that the tariffs increase from 10 to 20%. Then there's some targeted counter tariffs that China placed on the U.S. farm goods. Some of the food, like pork and chicken, I believe, took place just under 3 weeks ago. 15% tariff on some of the U.S. farm goods as a counter threat. So as we look at what's going on, there's certainly a lot of news. Maybe there's more drama in the headlines than what gets put in place for the most part. And so you can see the size, 28 billion of U.S. goods, et cetera. So when you look at the global economy, we're about $105 trillion. The U.S. economy is about $28 trillion. And if you look at exports, you can see these aren't tiny sums, but they're not covering all goods and services. So it's certainly measured to an extent, but there's tariffs, counter tariffs, as we step through the early days of this new administration. All right, so those are some of the news on tariffs, and let's get into the economic outlook. Who's more negative, banks or corporates? If you look at corporates, you can see, corporates anticipating a more significant economic outlook over the next 24 months. 13% of corporates, which is that orangish or goldenrod color on the left, 13% saw it as significantly greater risk. Banks is 6%. And that can be for a number of reasons, right? Banks have lots of customers. If you're a corporate, I guess you're in whiskey or alcoholic beverages, maybe you're seeing greater or significant risk. If you move down to greater risk, banks certainly see it much more negative. If you take greater and significantly greater risk, 67% on the bank side compared to 51% on the corporate side. No bankers identified less risk in any of these scenarios, yet 6% of corporates did. And so that might be if you were in aluminum or steel or auto. Those are some favorite industries for some of the tariffs that are being put in place. You could see how this could vary depending on what business you were in. So, comparable risk is fairly low. So most organizations are seeing greater risk with some of this uncertainty around tariffs, responses to those tariffs. Will it result in a better situation over time, or will it result in some trade wars? So there's more concern on the risk and the uncertainty as we look at over 2 years. Leo, I'd invite you to jump in on this if you wanted to make any comments here.
Yeah, for sure, Craig. No, quite interesting. Also, we've seen a lot of companies, be more proactive, especially the more forward-thinking treasury teams where they took action, a few months ago, right? So with the uncertainty has been bubbling up a little bit, so they've made changes on capital structures, they've made, additional inventory, purchases. So that's probably where, potentially there's a disconnect here between the corporates and the banks.
Yeah, that's a good point, right? Some of the being proactive on, I guess we've gone from just-in-time inventory from a decade or so ago to just in case, to just before, right? Just before tariffs. Maybe that's a new term. I also see that some people in the comments section have said they've acquired a sufficient supply of scotch or other goods. So appreciate the commentary there. Yeah, thanks, Leo. Maybe you could take us through some of the influences from the tariffs. What's happening and how are people reacting to this, Leo?
Yeah, so sure. So, if you look at these numbers, what they're really telling us is because even just the top two responses can give us a really good signal of what's happening, right? So, first, like nearly a third of the organizations, they're saying that the tariffs have led them to rethink how they manage exposure. So that's a big shift, right? It tells us that companies aren't just reacting; they're realizing that risk exposure is not something that you look just once a quarter. It's something you need to be managing dynamically, sometimes even daily. So this is where Treasury plays a real central role, right? It helps the business understand where the risks exist and how they're evolving and what levers are available to mitigate them. So that could be anything from monitoring currency fluctuations, counterparty risk, or just evaluating their trade terms, or just identifying their vulnerabilities, across regions or suppliers. So, Craig, I know this is a topic that you've been at the forefront on, which is the elevation of Treasury from an operational role to a partner, a strategic partner in the office of the CFO. So it's all about being proactive, not just protective, right? So the second key data point here that is just as important is that 22% of the companies are saying that tariffs have increased their projected needs for working capital or financing. And that makes perfect sense when you think about the mechanics, right? So tariffs can lead to earlier payment demands from suppliers, higher input costs, or even inventory stockpiling, we just talked about. So that puts a lot of pressure on cash. So suddenly, Treasury needs to reevaluate their capital allocation, their credit lines, and the liquidity buffers, everything in real time. So this is where Treasury becomes that connector between finance and operations. It's not just about knowing how much cash is available and how much cash you have, but also forecasting what the business will need, when, and then why, right? So making sure that the right structures are all in place. So what's powerful about these two data points is that exposure management and working capital needs is that ultimately tariffs are just a disruption, right? They're just a catalyst for change, how organizations approach their own financial resilience. And good news is that Treasury is at the center of all of that. So the teams that can identify risks early, align capital strategy with business operations, and build this flexibility, those are the ones that are going to help the organizations, weather this volatility, right? So as we continue today, I just encourage all of us to think about the shift is not just a reaction to tariffs, but just part of a broader evolution in the role of Treasury. So it's just moving faster and having a bigger impact than ever before.
Yeah, great points. That proactive footing or posture seems so good. I also found it interesting too that just about a third or 3/10, no impact so far, and then unsure 15%. So still a little too early for some industries, or maybe they're just not exposed to the direct or maybe the core secondary responses there. And that second to last one there, that we had or expect to have a positive impact, improve competitiveness or increase domestic sales. So you can think about what steel and auto. I always think about the protectionist trends. Every country has those. Lumber. The U.S. lumber industry strong, so we tax Canadian lumber. They protect some of their dairy by putting in tariffs. Right? There's all sorts of reasons. There's promises that are made. There's national defense concerns about certain types of activities, making sure there's industry. So lots of activity and certainly a number of influences. So thanks for your comments, Leo. This brings us to poll question number 1. So how has the recent economic uncertainty caused by tariffs or interest rate changes impacted your company's treasury priorities? So this is a select all that apply. So go ahead and select every one that applies. We have a no significant impact, second to last, and an unsure. So if that helps, that would be excellent for you to enter it and submit. And while that's going on, I did want to mention a couple of things. So there's a question: do we have a breakdown of the industries that responded to the survey, perhaps by NAICS, so an industry code? So that is a really good question. On our flash surveys, we make them extremely short. There's very few questions. So we're not asking industry surveys other than, are you corporate or a bank? We're not breaking it down to the level where you can say manufacturing, et cetera, that we have. So on most of our smaller surveys, our core surveys and our expanded surveys, those ask quite a few firmographic and demographic questions. We can break that down. We don't have all of that for this particular survey. That's a good question. And if you're filling out the poll and quizzes and submitting those will come in. I'll draw your eye to the webinar chat where you can follow Bottomline on LinkedIn and follow Strategic Treasurer on LinkedIn. So go ahead and click those and follow on LinkedIn if your computer allows you to get to LinkedIn. That is a delight for our marketing team, and that's why we put it in that box there. All right, Leo, your quick reaction. I think you're gonna be happy with the first one. 46% says increased focus on cash flow forecasting and as a provider of cash flow forecasting tools. Yeah, your comments on these responses.
Yeah, for sure. Isn't that always a problem, right? It's quite interesting how many companies still struggle with, an accurate cash forecasting, combining data, having 100% visibility across all of their cash positions. So, not surprised. I think we still see, in any survey where cash forecasting is a focus or an issue, everybody typically checks that box. But yeah, quite interesting breakdown.
Let's see, adjustments in working capital, a little over a quarter. Risk management and hedging strategies, 38%. So yeah, well over a third. No significant impact, about 1 in 6. Unsure, also about 1 in 6, 1 in 5.5 or so.
Yeah, hedging has been quite interesting, where you see not all companies have, their boards have, hedging policies, FX hedging policies forced on them. They are a little bit more reactive. But even for those that do, I wonder if the boards are reacting as fast as they should when it comes to reevaluate what mandates they have to the Treasury team when it comes to their hedging policies. Because you would expect that to be a little higher as well.
Awesome. Excellent. And I have also received in my ear, actually through a beep in my ear and through a specific message, we do have some industry breakouts. So there you go. I know we dropped the questions, but there you have it live. I erred in saying that we have those, so we can give some of that information. First, thanks everybody for responding to the first poll and quiz. We'll move that off the screen. If you would like to see the results of the poll and quizzes that we do live, we'll include them on these pages where you see the poll questions. We'll replace that with the results. If we get 150, just 150 people to type the word bottom line or tariff in the chat box. So whichever one you prefer to do, you can go ahead and do that. And we'll send those out to everybody as a follow-up for those who like data, right? For those who took the webinar or attending a webinar and want to see poll questions, we know you love data, which is excellent. We do too. All right, that brings us to mitigating risk, Leo.
Yep.
There's a couple of key things here. I'd love to hear your take on this.
Sure. Yeah, no, I guess, let's look how people are thinking ahead, right? So I think that the big striking number there is definitely the 51% of companies are saying that they aren't sure where to invest when it comes to risk mitigation. So basically, that's half of the market basically saying, we know there's a risk, we just don't know what to do about it, right? So this uncertainty really opens up a big opportunity, right? Because when the path forward is very clear. It's exactly when strong financial leadership becomes most valuable. It's not just, not about having all the answers, about knowing what the right questions to ask and creating the right frameworks for, good decision making. So among those companies, now looking at the rest of the numbers, so among those companies that are making the moves, the top area of investment is technology solutions to identify and monitor risk, right? That makes perfect sense. So we move past the point where risk can be managed on gut feel or spreadsheets, right? Companies are realizing that they need better visibility, faster insights, and then just a more integrated understanding of their exposure. So this is where now we have a chance to move forward from reactive to predictive, right? By using tools that bring together cash, data, financial instruments, the business drivers, so they can anticipate where the risks is going to emerge and then how they'll impact their liquidity in their operations. Now, one interesting point in these numbers is that if you look down, only 9% are investing tools specifically for trade or risk management. And that feels a little low, especially if you consider that today's risks are new, right? Cross-border trade, supply networks, payment cycles tied to volatile currencies, have been happening for a while. So maybe what this tells us is that, while many companies, they understand the need for risk management, they're still evolving, their understanding of where the biggest levers are and how do they align their treasury processes to those levers. So one other point here, which I found interesting in the responses, is just this reliance on consulting and data services. And that suggests that companies are still externalizing, or going out for a lot of their response. And that's helpful, in the short term. But on the long term, the resilience of the organizations really depend on building their internal capabilities, right? So smarter forecasting, faster access to data, stronger, internal collaboration between treasury, finance, AP, AR, operations, right? So all of that, breaking the silos, that's really the long-term strategy here. So, looking at what the takeaways are here from these numbers, I think is that companies, they just need to do more to mitigate risk, but they haven't really figured out how, right? It's, treasury, it's not just about protecting the balance sheet. It's about just building the resilience in their organization. So that means connecting all of these insights across their systems, aligning with strategy, and then bringing a better structure to make decisions under pressure.
Yeah, appreciate that. On the consulting side too, building greater resiliency, there's certainly things that are done internally. And I certainly have a bias from a consulting, as a consulting and research firm. We do see people using extra resources to, organize their banking structure, put in place, different types of forecasting tools and multiple models that they may be able to run themselves, but getting those things stood up sometimes requires those extra resources to do it. So it's kind of depends on the continuum of companies and what's occurring. I think the other factor too, as we've talked about this and we look at this, is how does Treasury prepare for different situations? I think there's an issue of we want to be able to see what goes on. We have certain assumptions, and then how do we prepare? It's like the old Boy Scout motto: "Be prepared." And then you ask the question: "Be prepared for what?" For anything. And so, how do you prepare for questions you may not know the answer to? Well, some of that is going to be where we are adaptable. We can change our forecast. We can run models. We can rely on the data that we're looking at. And so we narrow the range of volatility or how hard it is to respond. And that requires tech. It requires people that understand. So it's a good environment for Treasury to be able to adapt, because Treasury looks so much at the future compared to many other areas of finance, which is looking back historically. And so that's that posture. I forget the phrase you use, whatever that posture is, the proactive posture, Gil. I can't, Leo, I can't remember. There I go.
Active versus proactive.
Yeah, call me Jeffrey if I call you Gil again. How about that? That would be fair. All right. Well, as we talk through that, I see a lot of chats coming through, which is fun. It's a good way to continue the dialogue. What kind of conversations are being held with their banks? And so we asked about the question of the last 3 months, so a quarter, 13 weeks. Have you had a conversation with your bank on the impact of tariffs on your company or your industry? A third said yes. And that is key. Over half said no. 15% were unsure. And so that may mean, I'm not sure if somebody in our group has had conversations, if there's been a relationship conversation or not. So that's certainly taking place. So I think that's really interesting to see where that sits, about a third. But we also asked the bankers, and that's one of the key things on our surveys. We asked some similar questions, and we asked some varied questions between banks and between corporate treasurers. So the first one was, in the last few months, have you had conversations with your clients on the impacts on tariffs on them or their industry? And so a banker is dealing with multiple companies, maybe 20, maybe 50. A corporate may have conversations with 1, 2, 3, 4, 5 banks. And as we look at that, we have yes with many clients. A third of them have had conversations with a number of clients. 61% said with a few, and no was 6%. That no of 6% seemed fairly concerning to me. But who initiated those conversations? Very much a mix. Bankers are talking to their clients, being proactive, building relationships, and corporate treasury people are talking with their bankers about it. And some it was always the bank or it was always the client. And these are the questions from the banks. So that's a key thing for your conversations with your banks. What's going on? What are the risks? What are they knowing? What are they seeing? So very, very interesting to see that those types of responses. Gil, anything on that before we go to our next poll question?
Yeah, no, I find interesting as well as, the conversations happening between corporates and banks, potentially due to the financial instruments that these corporates have with those banks. The bank fees, as we all know, have been, increasing in certain areas, especially around trade finance. So potentially is where they're looking at alternatives to, to the financial instruments they have. But I agree, quite interesting that there is actually a good level of conversation between the two.
Yeah, excellent. All right. So that brings us to our second poll question. This is a select one. Which aspect of treasury management has been the most challenging for your organization in the current volatile environment? Forecasting cash flows accurately, managing currency and interest rate exposures, all the way down to implementing the right tech and tools, other or unsure. So go ahead and answer that. And we need 55 more. We need 55 more bottom line or tariffs in the chat box, and we'll share them with everybody. So I think we were at 95. I know we're down to 90. Yeah, some of them are typed in the Q&A box, but we'll count those. Brian will count those no matter where they show up. Awesome. All right. Gil.
There you go. Cash forecasting again.
Yeah. That's number one, like almost all the time. So, but number 2 and number 3 are, other unsure falls off, and then responding to pricing and cost fluctuations. That's about 1 out of 6, right? So, any thoughts on that or the currency? Any of your comments there?
Yeah, definitely. So, we talk a little bit about, hedging, right? A lot of companies already potentially have, a lot of treasurer just following their organization's mandates when it comes to hedging, but potentially the ones that aren't, right, are, maybe trying to look a little bit differently into how they react and, to currency fluctuations and, and again, like how they are working with their banks when it comes to costs and fees, right? That's a potential driver for that response as well.
It's fairly balanced, right? This was a select
Yeah.
one, so it wasn't pick your top three. So this seems actually fairly balanced, right,
Right.
on these
Yeah.
different areas, and that's one of
Yeah.
the challenges of the questions, right?
Yeah.
All right, excellent. Thank you so much, and thanks for popping everything into the chat box. Leo, this question is about, has management asked for additional information on the
Right.
potential impact of tariffs? Maybe you could talk us through this.
Yeah, quite interesting, right? Where, it's an interesting split we hear. 41% of organizations are saying that the management teams are asking questions, right? So there again plays back to, the role of the treasurer becoming more strategic, right? Like Craig, you picked the perfect name for your company, right? A strategic treasurer, and that's definitely evolving, right? And that's not surprising, right? Where, CFOs are likely, and boards are looking, at the treasurer to answer, where are we exposed? What are the cost implications, and what do we do about it, right? So when this request comes in, it's often pretty quick, right? So treasurer just needs to respond, like not in weeks, but in hours or days. And that's where the challenge typically comes in. So in many organizations, the reality is that information is just fragmented everywhere. So bank data is siloed, forecasts are buried in spreadsheets, and so on. So, when a CFO asks how will tariff affect our liquidity next quarter, the answer may take a little longer than it should. So, that's why, treasurer just needs to, have stronger data infrastructure and practices, not just for compliance, right, but for strategic readiness. And then, quite interesting, if you look down where 45% of responders are still, they haven't received requests from leadership. So, that may not mean that tariffs aren't affecting them, but just, mean that Treasury hasn't, being positioned as a go-to, sort of a go-to source, right, for this kind of strategic question and insight. So to me, that's an opportunity, right? It's a moment for Treasury teams to raise their hands and then say, we can help you quantify this. We can put the numbers around it. We can show like where the risks are and the levers to manage them. So, in today's environment, it's just not enough to manage risk in the back, right? So, this is more about, answering the CFO's questions, but it's just being in the room even before those questions are asked, helping raise the, the awareness and, make decisions.
Yeah, excellent. Thank you. Thank you for that. Right, the preparation for that. Thinking through different issues, drivers, maybe having different models. Those all contribute to it too. I'm going to jump to the side for a bit. People said, "What about industries?" On the front screen, you'd seen that 19% of the respondents were from banking. Then we have financial services like non-banking, non-insurance. Where 11%, manufacturing was 10%, business services, legal, et cetera, 7%. And then there's this whole list of every single industry tapering off from there. So a nice general mix of what goes on. Manufacturing is probably the only one that says a little lower than it normally is. It's normally a little bit higher than 10%. Tends to be the most favored industry for surveys, if I'm remembering correctly. But since I didn't remember that we asked those questions, we can't rely on what I just said. All right, so let's go to credit availability from banks. I'll take this one. What we're asking here was, are banks planning changes? Have they made changes based on particular industries due to tariffs? So we asked corporations if their banks had indicated any change, right? If there's something that falls very much out of favor. So, generally, yes, it was zero. Nobody answered that, but yes, there was for specific industries. And again, this is, let me correct myself. This is a question to banks. Some banks have made changes for specific industries. I would assume this is for industries that have fallen out of favor. And if you look over time, an industry may become impaired. It's got asbestos, or banks may be overconcentrated in an industry that may be facing significant headwinds or sidewinds. So, 33% no and unsure make up the bulk of the rest of those. So that's kind of a quick capture on that from credit availability from banks. So I think we understand that. And let's go ahead and look at our third poll question. So we'll pull that up. And this is all that apply. What tools or strategies are you currently using to improve visibility and control over cash and risk? So this is assessment of who's on here, what is going on. Are you using a TMS? Are you using AI and machine learning for forecasting, whether that's in a TMS, a receivable system, or you're building on your own? Are you using bank portals and dashboards, using hedging instruments in an increased level? Are you doing supply chain finance, right? This always picks up in challenging times. Is that picking up now? You using manual processes like spreadsheets or internal models that maybe not be so automated, but you're doing those to run different scenarios. What happens if this increases? This is a certain percentage of our margin or our costs. What if that changes 25%? What if that has this impact? How will that impact our sales or our cash flow, etc.? So go ahead and answer that. Hit submit. All right, Leo, we have the numbers are in. Number one, 60% is bank portals and dashboards. Number two is manual processes, right? Early days of change or uncertainty. And then treasury management systems, 46%. And then we've got a few in the 16, 12, 9%. AI machine learning for forecasting, which is still a pretty healthy number if you go back a few years, right?
For sure.
Your thoughts on these? Any comments?
Yeah, I think that, first one that breaks my heart is manual processes, right? Still lots of companies, relying on manual processes, spreadsheets, internal models, and, it's, even though their answer is, I would suspect if the follower is, are you happy with your process? The answer will be no, right? It's just very difficult to be quick and agile and in today's environment with lots of manual processes. Quite surprised about the bank portals and dashboards as well. I think, in a lot of, especially lots of companies who have been diversifying, their banks, they've been forced by their boards sometimes to have multiple bank relationships after the issues we had last year. Quite interesting that they're also relying on that. That may be a connection between their manual processes, not having internal systems if they are constantly using their banking portals in order to build a strategy as well.
Yeah. Thanks everybody for answering the poll question. So I see that it closed too quickly for some of you. Apologize for that. I know it's sometimes that's a challenge. I apologize that happened. So, well, we'll move on to preparing for tariffs. Leo, if you could start us off here. It's like we've talked about what people are thinking of investing in, what are their attitudes and what are their views. Maybe you could take us through some of the preparation activities here.
Yeah, for sure. Yeah, this is all about action, right? So, what steps are the organization that's taking to prepare? So if you distill this down, there's really two clear patterns here. So one is identifying exposure, and two is increasing financial planning efforts, right? So let's start with the first one. So 47% have taken steps to identify their risk exposure. So that's really the first move, right? That makes a lot of sense. So you're gonna where you're vulnerable, and then where is it tied to suppliers, regions, currencies, timing, and identification is really key, right? But it's just the first step. So the next step is a more strategic one. Is how organizations are planning to manage those exposures. So that's why there's a lot of pressure. That's where there's a lot of pressure actually within the finance functions, right, to basically turn this identification and awareness into action. So it's not just about risk mitigation, it's about enabling the data-driven decisions where really goes back to like strong cash management practices. They become the foundation of the agility of the office of the CFO, right? Because with increased uncertainty, the most important question is like, do we have liquidity to move? Do we have liquidity to pivot? Can we absorb some inflow delays, or can we absorb some higher costs? So, quite interesting where a large percentage fell into that group. And then the second group, you think about it, 24% of the companies are running models of scenarios, but only 23% have researched alternative options. So there's a pretty big gap there, right? Where, it shows a broader challenge, right? So two companies are talking about volatility, but not enough are stress testing their positions in scenario planning with real world conditions and scenarios. So, again, that's where scenario planning becomes, a game changer for a lot of companies. So take it out, just to, bring it to more of a real life scenario, right? Take a company that has, is active in global trade. They might have, they've been using letters of credit, letters of guarantee across different regions. So if the tariffs or the shipping delays impact like a shipment backed by an LC, then that can affect their cash flow and their bank exposure, right? So scenario planning isn't just, a theory, it's just part of the operation of that organization. So what happens if a guarantee is not released on time? What happens if, you have, delays that extend like drawdowns? So what we've seen is that organizations just try to forecast and model not just on cash, right? So, you start looking at things like timing, timing of inflows and outflows, and also the flow of financial instruments. So that insight just helps them prepare more broadly, and more accurately, actually, across, all of their functions, and then respond faster. So, when we see customers using like our platform as an example to support this kind of forecasting, what I think it matters most is this mindset shift, right? So for moving from we're just reporting, to we're ready, right? So from we're just collecting data to now we're enabling decisions. So, the path here, the key takeaway, I think it's the business aren't just like, doing anything. Just they just may not be seeing the full picture. So again, I think that's where, in this point is where like strong financial practices, strong cash visibility, dynamic scenario modeling, integration across all of your trade finance functions can make you, more prepared and more resilient in these times.
Yeah, yeah. Thank you for those comments on what people are doing in prepping for the tariffs, and then some of your advice on that as well. I'm curious in the chat box on the added monitoring for more frequent gathering of information, data, or news. I mean, certainly, you can pull more data on your banking information, let's say from just prior day to, current day, or pulling that. But what about news? Is there anybody who's pulling information more frequently on news, whether it's related to tariffs or other geopolitical items? Like, is anybody pulling that more regularly as a group? Not just you're looking at news more regularly, but you're doing something systematic in the Treasury group. I'd love to see anybody say, news or something in the chat box, just so we can see how much of that's occurring as opposed to just data. And I think I see a few people doing that, pulling it. Okay. Yeah. Look at that. Okay, so we're up to about 25. That's that's awesome. Okay. So this is really taking off. That idea of now we have tools. I guess, Leo, like that, what's a standard of good corporate conduct? What's the minimum standards? Is I need to see what's in my accounts, my balances and the transactions on a daily basis, all of my operating accounts. That seems to be the minimum standard, not once a month. You need to do it affordably. You need to do it. That seems to be a minimum standard. And I guess when we look at news, and hearing headlines and coming from multiple sources to try to see how that may influence trading partners, certain materials, if we're in manufacturing, or certain supplies that we're pulling together. And I think that's that's a way of pulling in more information that's maybe hasn't made it to the numbers. It's influencing sentiment.
Right, exactly. Yeah, no, for sure. Ultimately that goes back to scenario planning, right? Is, as you're gathering more news is to be able to then, adjust your forecasts and adjust your, where your expectations were of inflows and outflows or additional costs, or, be able to model these different scenarios for, where things may be in the future, and then see where is your business going to be and what should you do about it. It also goes back to, yes, it's all about cash, but ultimately, especially a lot of businesses who are mostly impacted by tariffs, they are likely within, they'll have additional financial instruments. So can they bring all of that data together in one place, which we've seen a lot of businesses not be able to do that well, where sure, I can, I have all of my cash. I have a tool where I can bring in all my cash positions, and I have a cash forecasting tool that I've implemented in my business, but my financial instruments are separate right there. I have to look at them in a different place. And that becomes a challenge because they're all part of the same problem, right? So being able to bring it all together is really key. And again, like being able to adjust, and sort of adjust your dials or your scenarios as new news come in, every day, every hour is really important.
Yeah, excellent. And thanks everybody for responding as well to those. As we shift to some final thoughts, I did want to, there was a comment about would it be helpful to have a timer for when we're running the poll question. We use a timer in our FinTech Hot Seat head-to-head sessions. That seems to be much loved. I'm surprised at how much people love that. If you'd like to see the timer on the poll questions, I'd love to see some people type it in to see if that's something we can drop and incorporate there. But as we've talked through this, again, thanks everybody for your commentary within the survey and engaging in the content here. But let's go through the final thoughts, and maybe Leo, you could kick us off, and I'll finish up on this one.
Yeah, sure. Yeah, so let's start just focus on a few things that came up throughout the discussion, right? So really, how can we help strengthen the treasury position within a financial organization? So starting from managing cash flow. So what we're seeing is that the tariffs and just the broader volatility are forcing companies to look at liquidity differently, right? It's not just about balance sheet strength, but it's about access, about timing, about flexibility, adaptability, right? And what we're hearing from companies is that they're just reevaluating how they fund trade, for example, right? Like take a company that like traditionally relied on letters of credit, right? But they, because of the compliance burden, like bank fees, or just how much they tie up the credit line, they may moving some of the less risky suppliers to supply chain financing model. Now they're rethinking their approach, right? So what really emerged from this process is that it wasn't just a change in the trade finance strategy of the company, but it's just the realization that cash and credit instruments need to be part of the same view, right? So they need to not see when cash is moving or in and out, but also when say their guarantees are being issued, when those flows may change and create like a pinch point on their forecast. So that's just a a great example of how Treasury isn't just managing money, right? Anymore, right? So just simply managing money as typically the function does, or complying with your board's FX hedging mandates. You're just managing the mechanisms that enable the business to operate. So especially when these conditions change quickly, like we've seen with tariffs or trade routes or regulations. So that brings us to the second point, which is automation, right? So there's just a growing recognition that many treasury functions are just too dependent on manual processes. Take the answers we just had in the last poll question, right? So gathering data, reconciling data sources, and then producing reports, and that's just not sustainable. Especially if with the pace of change, that it's accelerating while everyone is looking at the news every day, right? Treasury just needs to be responsive more, real time. That requires basically eliminating all of this friction whenever it's possible. So, some of the most forward-thinking finance teams that we worked with, they're basically now fully automated. They have all of their daily cash positions across all of their banks, vision of that 100% in real time. They can forecast cash financial instruments, all in centralized view, and automate their entire process so they can essentially close their books quickly, right? So this is not just like about saving time. It's just about providing a higher level of confidence to the office of CFO and your whole organization, that you can not only identify risk, but you can also manage risk and make data-driven decisions. So, and lastly, automation is not just doesn't really replace judgment, right? So we have to think about all of these tools and capabilities as another member of your treasury team, right? So what we're really talking about here is just shift the focus from chasing data, to helping shape and determine strategy, right? So as we think about moving forward, especially like with these tariff uncertainties, all of these capabilities for automation, cash flow visibility, intelligent forecasting, automation, they are just the pillars of a stronger and more adaptive treasury function.
Yeah, thanks, Leo. And so everybody's aware, Leo and I are recording and we'll be releasing shortly a podcast on one particular or a couple of particular aspects of the research here on tariffs. So look for that. That will be coming out very soon. And we're so glad you listened to us during this webinar. So that'll be another component. And I guess too, I would be interested in the chat box as well. If you would like a refresh of this data, maybe some different questions as well, in 2 months and 3 months or 6 months, if you're interested in seeing another flash survey, go ahead and put the frequency you'd like to see, like in 3 months or 6 months, for example, to see if that makes sense, just to gauge how feelings, attitudes, perspective has changed. So just if we get a whole bunch of responses, that may help us. That gives us some really good data daily. I shouldn't read the box sometimes. That's just moment by moment, every time we come in. Well, let me turn the attention to the be proactive, and I'm going to tell it more as a story, Leo. Here, it's it's easy to say be proactive as opposed to reactive. And some of the questions: how do you prepare for some things that you may not know about? Right, certain macro geopolitical issues, wars, maybe different types of tariffs that come in, and using the art of the deal, creating uncertainty. I mean, there's a number of things that can come up. And I will use the Boy Scout motto, being prepared. And they have the answer is, what are you prepared for? Well, anything. Okay, that's pretty general. That sounds great. What does that mean? And so they have something, for example, of the 10 essentials, which is the backcountry 10 essentials. So if you're out camping or backpacking, you have certain things, something to protect you from the weather, something you can start a fire, direction, more for a water source, not necessarily food, because you can live a long time without food, but you can go through the 10 essentials. And what does that give you? That gives you time to protect yourself if you get trapped or you run into a particular situation. And you have more time to recover. And so because you might not know exactly what's going to happen, how do you have more time to prepare? Well, if I have a more active forecast, or I can run models that can help me put information into it, or run my models to see how much cash I'm in. If you have, let's say you're capturing more news and information prior to it flowing through and coming through some of the statistical or government reported data, it might give you a little bit of a leg up. So you can say, this is an issue, that's not an issue. I can buy more of this information. I can offer a higher rate for prepayments. It gives you some additional areas of flexibility. And so being better armed with technology with data, with models and potential response scenarios, a better playbook, if you will, that's a way to be better prepared. That won't cover everything, but versus the response of, well, we couldn't have known about X, Y, or Z. We may not know what those are, but there will be those situations, like when COVID hit. I mean, you should have seen what happened with the numbers in COVID. We were doing research there, and the massive amount of people that were concerned on the receivable side and the delay of payments and how that impacted organizations was extreme. And so we have models of extreme, moderate activities. So knowing that some things can happen, but not necessarily knowing what can happen, allows you to respond quickly. So that idea of being proactive, 68% were looking and considering and doing actions related to tariffs. 41% of management had asked them to do that. There's nothing that prevents you from taking initiative to guard against risk. And so if you list and look at some of those items to see what you can do, what others are doing, that can give you some guidance and ideas for what maybe your organization can take on. Maybe you're assigning certain activities to different people. Maybe you're sharing those with broader finance, not just treasury. But you don't have to wait until you're told before you take initiative to guard against risk. So that's our final thoughts, taken from that. Leo, thank you and Bottomline for underwriting this research. This was really helpful, and this was really fast. I mean, the survey closed last week. We did analysis this weekend, have it out, and you can download the report now. So thank you, Leo. Thank you, everyone.
Yeah, thank you, Craig.
And we'll turn it back to Brian. He has a few announcements, and he also listed the link for downloading the report. So go ahead and download that. And back over to you, Brian.
Well, thank you, Craig. Thank you, Leo, and thank you, everyone, for joining us today. The CTP credits and FP&A credits, today's webinar slides, and a recording of today's webinar will be sent to you within 5 business days. And as Craig mentioned, for more on tariffs, be sure to download the Tariffs and Treasury Survey Report by clicking the link in the chat box. Thank you, and we hope you have a good rest of the day.